Can you imagine when a politician says, we want prices to be cheaper, we want affordable housing? You can translate those words into, we want the housing assets that all you homeowners own to be worth much, much less. We want to basically take or steal hundreds of thousands of dollars from your balance sheets. It's the same thing. That's what affordable housing means. I think this is why we end up with a lot of talk in the housing market. There's a lot of media debate, but at the end of the day, quite often there's very little action because politically, you're going to create a lot of winners and a lot of losers. I call it the symmetry of property markets. That is why we end up with all these hoaxes, these myths, these stories, because we have to lobby for our interests while avoiding that obvious truth that any big policy that makes housing cheaper just destroys wealth from the majority of households.
What will be the outcome for those that want to buy a house and can't?
Whatever's happening right now, we always think, this is never going to end, nothing will change. Prices only stay there because someone's paying that price. If people can't buy, the prices will come down. I don't know how, whether it's going to be a big crash or a period of prolonged stagnation, but you've got to sort of trust the economics that prices will come down, interest rates will come down, or household incomes will go up.
Yeah, I wish I shared your optimism on wage increases. I think we have a lot of forces that businesses are dealing with. People are cutting labor, cutting costs, layoffs are happening.
Yeah, it sounds like there's going to be a correction to me.
Dr. Cameron Murray, thank you so much for coming on our show. I'm excited to dive into things with you. You're in Australia. You're an economist. And last year you published a book, which I have, and I've perused the book. I'm looking forward to diving in. I just bought it a couple days ago, but called The Great Housing Hijack. And as you were recommended by one of our guests, and so I want to learn about you. So, sir, if you could just tell us a little bit about your journey, why you wrote that book, how you took your PhD, how you took your career and focused in housing. So we'll get started.
Oh, thanks for having me, Todd. Yeah, so I'm an economist. I'm an Australian, and my background is in property. My family were property investors. My dad, very big on investing and owning property. And I ended up studying at university a degree called property economics, and that took me into working in private developers in Australia. And that's sort of where I got my kickstart on property. I can probably skip forward. Ended up doing a PhD after many frustrations in my career into grey corruption. So I also wrote a book called Rigged: How Networks of Mates Rip Off Everyday Australians, which was my sort of deep dive into political favouritism and the revolving door in Australia. But since then, I've really been back focused on property and housing. And I ended up writing The Great Housing Hijack, really to just put in one place how I see the market working, how I see all the myths and stories that get generated from the industry and from vested interests, how I see those hijacking our policy debate. So I just thought someone's got to put all this stuff in one spot and make sense of it all. And I guess that happens to be me. If no one else will do it, I'll do it. And still every day I'm frustrated by the storytelling and the myth making of many interest groups around what causes house prices, for example. Where do rents come from? And I'm hoping that book sits there as a bit of a legacy that people can refer back to.
What is happening right now with the Australian housing market?
Yeah, so I guess we had, like everybody, the post-COVID boom, the low interest rate, stimulus-fueled property price boom. We also had a lot of rent appreciation from 2022 to 2024, which has sort of stopped now. And a lot of that was just the inflation pulse that happened globally. And so I think the good rule of thumb for US listeners is that Australia is about 18 months, a year to 18 months behind the US in every market, whether that's during the financial crisis or now, whether it's the property market. And so things are at this sort of quiet plateau, you might say, in many areas. And there's a bit of nervousness, and then there's also a little bit of optimism of builders and developers because construction prices have finally stopped rising and even fallen for many materials. So that's sort of where we're at, which wouldn't be too dissimilar, I'd imagine. Is that right, to the US?
Yeah, you're right on. Let's talk about the pandemic boom a little bit, and even before. Here in the United States, I'd say for probably the better part of the last decade, because we went through the GFC, which affected, it was a global financial crisis, actually. Where we really saw the housing market fall apart and a lot of foreclosures. And so for like the last 10 years, or maybe even a little bit more than that, a large percentage of the buyers of our single family home inventory have been investors. We watched when the Obama, back then it was the Obama administration, sort of took office in the middle of this crisis. And, banks were failing and, foreclosures were happening to the tune of millions and millions of households. And what they did was they basically bundled up these defaulted mortgages and they sold them to Wall Street companies and hedge funds, and they bought them, by the bulk. And, their responsibility, or with the understanding that they would turn these houses, they would take the neighborhood plague over, end the plague, because as you can imagine, maybe it was even the same there, but you could drive down the street and see grass 3 feet tall, houses were boarded up, you could clearly see they were abandoned. So what Obama, the administration, had designed was this, we'll off these to the investor, these funds, a lot of them, for pennies or nickels on the dollar, but they had to clean up the plague in the neighborhood, make sure the grass was cut, make sure the homes were onboarded, and that they rented them back to the people that lost their houses. Not the same people, but they turned them into rentals. Well, what happened was Wall Street really got a good taste of that because they saw, hey, this is a market that we can make not only money on a rental basis, but we can gain the appreciation that's been happening and sort of, upsell that or, make money off of that. What was the percentage like of investors during this same period? Was it pretty high, investors buying up your inventory?
Yes, so I'm just having a look at some data now on the US. If people are interested, the home ownership rate, so the proportion of all dwellings owned by their occupants that live in them, was 69% at that peak pre-financial crisis. And in the US, it dropped down to 63.5% by 2016. And Australia also had a decline in home ownership rate between sort of 2011 and 2016. That was our biggest drop in home ownership, which has since bounced back a little bit. We had a 2021 census. So yeah, I would say it was a similar trend. A lot of first home buyers or owner occupiers have been burnt a little by those adjustments. And then during this sort of upswing of the next cycle, we saw really it was the investors who were willing to put their money back into the market. So yeah, not too dissimilar, but Australia's financial crisis was nowhere near as extreme as the United States. There was no foreclosure wave here. Prices adjusted a little bit, but we had a lot of stimulus focused on the housing market, which sort of arrested price declines. But the underlying trends were there in terms of the decline in home ownership and the dominance of investors. And so actually what happened in the middle of the 2010s, we had sort of the biggest apartment construction boom in the history of the nation, focused particularly in Sydney and Melbourne during those 2010s, because that's where all the investors ended up. And there are many sort of tax reasons why Australian investors like new apartments, because they get to deduct a depreciation schedule from their taxable incomes. So yeah, I think there's a lot of similarities, but a little bit less of the extreme swings that the US saw.
Yeah, well, we have the same thing with the investors. They can depreciate the structure, over the period of 27 and a half years. And, so probably pretty similar to
Yeah.
Australia. In your book, and I want to dive in a little bit. And by the way, guys, you can check out in the show notes. We have a link to the book. I highly recommend you check it out and buy it. You could download it on Kindle. It's not that we're not making money on it, so I'm not just telling you that. But I think you will see a lot of similarities that we're going to dive into and sort of just touch on now. But in some of the highlights in the book, really you discuss how everyone claims to want affordable housing, and that Australians on regular incomes dream about lower home prices and rents, and that's the same here. I mean, we kind of have this funny narrative that politically speaking, that everyone wants affordable housing, but not in my neighborhood. Put it over there. Don't put it here. Don't put So you also talk about how these property insiders, sort of the corruption, shapes the housing market, which I kind of feel like when you're suppressing here in the States, you're suppressing interest rates, and you're allowing people to buy 30-year fixed rate mortgages and 2 and 3 handles. It allowed these prices to skyrocket, and now they're trying to sell the houses for the same prices at 6 and 7 handles interest rate. So you also discuss hoaxes of the cheer squad and how they hide the brutal truths. And, I talk about it all the time. I feel like the mainstream media is pushing the cheer squad. If you don't buy now, you're going to miss out. You can always refinance later, date the rate, marry the house. And also you talk about how that for every winner in the housing market, there's a loser. So, let's
Yeah.
dive in a little bit to
Yeah.
this and kind of, let's talk about your assessment of what has happened since the pandemic boom.
Yeah, so that's a good point you picked up on there. I call it the symmetry of property markets, right? So there's a market price, and any policy we do to intervene uh, to make rents or prices higher or lower has two effects. One, if the renter might get a cheaper rent, but the owner gets a lower income, right? The landlord gets a lower income. So there's this kind of symmetry problem, and that reveals itself politically when you can have a politician have breakfast at, for example, a property industry event and promise that we're going to have lots of investment in your industry, and there are going to be great returns in your industry. It's the best industry ever. That's what a politician might say. And then at dinner, they'll go to an event with the Renters Association and they'll say, "Oh, we promise you guys cheaper rents and more affordable housing. There's nothing we like more than supporting our renters." And I ask the question, well, which is it? Because cheaper rents is dollar for dollar equal to lower incomes for those guys at breakfast that you promised you're going to support the industry. So I think this is why we end up with a lot of talk in the housing market. There's a lot of heat, there's a lot of energy, there's a lot of media debate, there's a lot of vested interest, but at the end of the day, quite often there's very little action because politically, you're going to create a lot of winners and a lot of losers in any policy. And I think the electoral calculus falls a little bit like this. In Australia, it's 67% of households are homeowners and 33% are renters. So it's about 30% plus some public housing tenants. And so if you've got 2/3 of your electorate that's going to lose if prices and rents fall, what's the logic? Well, you do anything you can to avoid that, right? And so I think that's one of the issues at the heart of the debate. We all pretend as if there is some kind of political opportunity to do something meaningful when the reality is there isn't. I mean, I think I put it in the book. Can you imagine, when a politician says, we want prices to be cheaper, we want affordable housing. I mean, you can translate those words into, we want the $11 trillion of housing assets that all you homeowners own to be worth much, much less. We want it to be worth 7 trillion, not 11 trillion. We want to basically take or steal hundreds of thousands of dollars from your balance sheets, please. It's the same thing. That's what affordable housing means. Now, not affordable as in non-market subsidized housing, but affordable as in the market price falls substantially. And so we sort of avoid that confrontation. We talk past it. We ignore it in all of these conversations, as if, governments, oh, no, we're going to change this tax here and we're going to change the planning scheme there. And suddenly that will wipe trillions from your balance sheets and houses will be cheaper and everyone will be happy. I'm like, that's not a real situation. Just think it through. Just think through. All those people who just got a mortgage to buy $1 million house and now their house is worth 700,000. They're going to be happy about that? In what world? So that's sort of the symmetry part that you picked up on. And I think that is why we end up with all these hoaxes, these myths, these stories, because we have to lobby for our interests while avoiding that obvious truth that any big policy that makes housing cheaper just destroys wealth from the majority of households. We just have to ignore it. So we talk about sort of all these magical things. Oh, we're just going to upzone, and then through the magic of the market, all these property developers who own property and make money when house prices are higher are going to magically miscoordinate and undermine each other such that they all make less money and prices will be lower.
Yeah.
Maybe, but I've looked at history, and you probably remember I looked at the 1850s in colonial Australia. In fact, in 1836, Charles Darwin, the biologist, was circumnavigating the globe, right, studying the finches and the animals, and he arrived in Sydney in January 1836. And the first diary entry when he arrived in Australia, this botanist biologist, instead of writing about the kangaroos and the koalas and all that, he wrote about the people who in Sydney, when there were 19,000 people in New South Wales, were complaining about the high rents and difficulty in procuring a house. This is before we had a federal government, before we had taxes, before we had town planning, and here we were, houses are unaffordable to everyone, everyone's complaining. So that's the sort of big picture, broad context that I think everyone needs, and it should make you skeptical of what people say and what they promise when they say, oh, this policy is going to fix that, that policy is going to fix that. Because fix for one person might be ruin for another. And if we ask those questions, maybe we can get to something more sensible, and it also might help us understand how the market actually works. Because there's this sort of weird view out there that the housing market, prices just come from the sum of things that go into houses. You add the land, you add the construction cost, and that equals the price. That's not where the price comes from. The housing price, it's an asset, and people can swap their cash from housing assets to stocks and shares to bonds to lots of different assets. And the market forces are going to determine the market price of housing based on the returns or the relative returns of those options. It doesn't matter what it costs to build, the market will always lead to that price. So anyway, that's sort of the big picture, Todd.
When you talk about the builders and the developers, and I'm with you. I mean, if somebody buys $1 million house, the last thing they want to be is $300,000 or $200,000 underwater on what they owe for that house, and they're paying. And in fact, in the U.S., a lot of people walked away from their mortgage not because they had a subprime loan back in the GFC, but for that reason. The people were buying the house across the street that was similar to theirs for hundreds of thousands of dollars less than what they paid. So they're like, well, why am I going to continue paying this mortgage? They just bailed on it. And right, why would a builder go in and say, well, let's race to the bottom and see what we can give away, or be the cheapest guy in town? But what role does your government have as far as, property taxes to have reason for wanting the values to stay high? Are you dealing with property taxes where everybody every year pays an assessed value on properties?
Yeah, so in Australia, the main property tax is this state. We have, all our councils are funded by property taxes, and the states have a land value tax, and the states also have a stamp duty, so a transaction tax. And it is true that the states make more revenue when the prices are high and the turnover of property is high. But it's not really something they can control, right? They can put the stamp duty tax rates up if they want to make more money, but people will trade less often, right? So it's not clear exactly what the net effect of that is. But yes, there's certainly an incentive, but in many ways, it doesn't matter what the market value is when you raise money from property taxes because you control the rate in the dollar. If you want to raise more revenue, you put up the rate in the dollar. And at the same market price, you can raise more revenue. So I don't think there is any perverse incentive from states to do that. It just so happens to be that property is a very easy and good thing to raise revenue on. But there's another interesting point that I think is often missed on property taxation is that property taxes make market prices lower, not higher. People think, oh, property taxes make my house more expensive. It's more expensive. But the example I use is if you want to buy shares in Apple, and imagine Apple has two different shares, Class A shares, which are the regular ones, and Class B that come with a tax of 2% per year. Which one's going to be cheaper? Well, the Class B shares are going to be much cheaper because people are going to pay less in the market price because they know they've got that tax liability to pay. And so taxes reduce the market value of homes. And there's this, as I say, there's this incentive out there for property owners to say the opposite. I don't like paying taxes. Therefore, what's something people think is bad? Oh, high house prices? Do you think that's bad right now? Oh, okay. The taxes I pay make your house worth, the house you want to buy, not your house. Because remember, if you own a home, you want it to be worth more. If you don't, you want it to be worth less. And so you end up with this story that, taxes make the price of your home higher when in fact the tax makes it lower. Um, and it's obvious to anyone who trades in asset markets regularly, but for some reason, the media will report these claims uncritically every day. In fact, in recent months, we've seen in Canada a real big push, development contributions to infrastructure are now suddenly a big deal and making houses expensive. And in Australia, we just last week had a new report out from a lobby group saying that it's taxes that are making the house prices too expensive at the exact time when prices have started to fall, right? So I think, taxes and property, there's lots of stories around this, and I don't think there's a strong political incentive to somehow manipulate the market price to get more taxes. And I think we also forget taxes make property market values lower.
I hope you're enjoying the interview so far. I just wanted to take a brief moment and let you know that this podcast is brought to you by SachsRealty.com. Here at Sachs Realty, we're committed to bringing you the best real estate education and helping buyers and sellers achieve their real estate goals. If you haven't subscribed to our channel, please consider doing so now. And don't forget, we're on every major social media platform, so you can follow us there as well. Now back to the show. That's an interesting point that you're making here, and it's almost so it strips equity away from the property owner when the taxes are high, because you're right. If you look at it, and I just had a deal fall through where a buyer was going to buy this property in one of the highest in our state of Maryland here in the United States. In Frederick, they have one of the highest property taxes in the state. and the property taxes were so exorbitant that the buyer did not want to pay. In fact, a home sat on the market for quite some time, went through multiple price reductions before somebody ended up buying it because the property taxes were so expensive. And that was their rationale, is to not buy it. Or if they did, they were going to offer so much less money so that they could guarantee like 10 years of, recouping the high taxes. And the same goes with the HOAs and the condominiums. When these fees go higher for the HOA management or the repairs or maintenance of the communities, that suppresses somebody's ability to maximize their equity in their home when they go to sell. But at the same point in time, it burdens the people that are on fixed incomes, where their properties have their value is being taxed on an increasing value, and then they're limited in their income. Maybe they're in their 60s or 70s, their house has been paid off, and now they're burdened with higher property taxes. They don't want to sell, but they have to because they can't. It's like a mortgage payment, and their pensions or their Social Security isn't enough to pay the property taxes.
Yeah, that's actually, there's a few elements that you mentioned there, Todd. On the high homeowner fees, what do you call them? We call them body corporate fees. So all the owners of an apartment complex form what we call the body corporate, which is an association that manages the building. Yeah, it's quite interesting because there's this policy view that we want retirees to downsize from their big houses into their apartments and things. But what you find is that the actual ongoing costs of being an apartment owner can be quite high, because you have to maintain not just your little apartment, but contribute to maintaining the whole building, whether it's got a pool and a gym and an elevator and a basement and car park and all those things. And so you find that retirees don't want to do that, because they'd rather stay in their big house and effectively live off the depreciation of the building during those low income years, rather than live in an apartment where they can't do that because they're obliged to contribute. So we definitely see that tension here. And it's sort of becoming a bigger issue uh, as the baby boomers sort of retire and downsize. The other point you mentioned is that there's a debate in Australia that because our property taxes on our own residents are quite low, we're exempt from state property taxes, or what we call land taxes. And so there's this policy concern that there is a lot of retirees in big houses in the suburbs with one or two people in them, and they will never sell and downsize, freeing up these homes for young families. Now, there's a few sort of elements to this story. It makes intuitive sense, like in a physical sense. Oh, look, there's a big house, there's only two people in it. But I guess the first thing to remember is we don't allocate homes by need, we allocate them by price. Just because a young family might want to live in a big house doesn't mean they won't get outbid by an even wealthier retiree who wants to move and upsize into that big house and is happy to pay a gardener or whatever the case may be. So it's not automatic that houses get reallocated in the market to those most in need. It will always get reallocated to those who want to pay and have the ability to pay. In fact, um,
Hmm.
yeah, so that's sort of a warning. And let me say this. In Canberra, so in Australia's capital, Canberra, the ACT, it's the Australian Capital Territory, they changed the stamp duty rules. So that's the transaction tax. They got rid of them for over 65s and said, we want old people to downsize and free up the homes for young people. This was after the financial crisis, so around 2010. What they found is that instead of downsizing, most of these retirees were upsizing instead, because they're the richest cohort of people in the whole country. And what do you do when it's now cheaper to buy and sell a house? Well, that upgrade that you wanted to do, you can now do it at a lower cost. And so they had to end up putting a market value limit on this discount to the transaction tax, because retirees were upgrading instead of downgrading when you allowed more transactions in the market, or when you reduce the cost of transacting in the market. So it's a really funny situation. And I think one of the other errors we make is to assume that in the absence of certain taxes or certain rules, which exist sort of everywhere to varying degrees, that the market would sort of automatically lead us to this beautiful distribution that's so fair and equitable, and every young family can just live in the best suburb in the biggest house because they deserve it. That's exactly not what happens. I mean, we had frolicking free markets in property in the 1800s, and all we had was urban slums and huge urban inequality, right? So we've had that experiment, and we know that that's sort of what happens. And anyway, so yeah, your point on retirees and costs is good, but there's a few misunderstandings around that, even though there's a huge policy interest.
So does that describe the wealth gap? Are you seeing where the generation, X or what we call the baby boomers, so
Mhm.
really from that 55 to probably 75 age bracket has the bulk of the wealth?
Yes, it's true here as it is everywhere, and that's partly because there happen to be an abnormally large elderly demographic. So, the baby boom is this sort of pig in the python as it's being digested through the ages. It's an abnormal lump, right? And so it's usually the case that the older cohorts own the most wealth, but it's abnormally the case for the baby boomers, partly because of the timing when they were born after the Second World War and the sort of rapid growth during their early adult years where they could accumulate a lot of wealth. And secondly, because there's just a lot of them. And I'm not sure what the sort of debate is like in the US, but in Australia, one of the big concerns is what we call the bank of mum and dad, which is wealthy baby boomers subsidizing the home deposits of their children with cash gifts, which many people think is amplifying the inequalities of wealth down the generations via the property market. And full disclosure, back in 2002, my dad gave me $30,000 to get me into my first home as an investor. As I said, he was big on property investment. So it's not exactly new, and I know a lot of people in that era who also got cash, but um, yeah, this is a real concern. Is it also the case in the US that people are worried about this generational transfer?
Yeah. So what we experienced during the pandemic boom, um,
Mm.
and again, I've been in the housing market for a long time. Since 1989, I started as a contractor, swinging a hammer, basically. So I've seen a lot. I've seen a lot of changes in, you know, and not just the composition of the home itself and how those trends have sort of changed through the years, but really how people acquire these houses, or their how they become homeowners lately has been a large part on, do they have mom or dad that can give them money, just like you mentioned, to have a down payment for their home. And what we saw here in the U.S. was during the pandemic boom, when asset home prices were skyrocketing, and the competition, and we had the investor market competing, and we had the first time home buyers going head to head, because incidentally, um, the investors are interested in the same housing that a lot of the first time buyers are interested in, that entry housing, because that's where the investor can go in and make the rents work, as far as their return rates and things like that. They cash flow. You can't buy a $1 million house and rent it for $10,000 a month necessarily, but you could buy a $250,000 house and rent it for $2,500 a month. So, it was the biggest competition amongst our first time buyers, and mom and dad were giving them money to actually pay over appraised value. So what we saw was, the house is selling for 250, but it ends up selling for 300,000 or 310 or 320, 70,000 more, because mom and dad gave them the extra cash to say outbid that house and get it. That the you need the cash to be able to buy it, because the house wouldn't appraise. So we watched that happen. Now we're seeing where the parents with the money or the grandparents with the cash, they are actually paying for the house because interest rates are in sixes, mid sixes right now for a 30-year fixed rate mortgage. So what they're saying is, look, you can't afford that payment at today's prices. We'll buy it in cash. We'll do a note. You pay us 4%, 4.5%, and you pay us the mortgage payment. So we're seeing that happen, even up to the $1.5 million range, where we're seeing, a lot of young doctors and executives that are buying these very, these larger homes. And mom and dad are still writing checks at that level, $1.5 million. Yeah, it's crazy.
Yeah, no, it is. So there's a couple of I haven't heard of the lending to your own children, but that makes a lot of sense. Just thinking out loud for a moment, there is a question of whether that changes wealth inequality at all, or whether this is just an observation of the same underlying process. Let me explain what I'm thinking here. Like, I can lend that cash to my children at a discount, and that discount is still kind of a gift to them. But I can also put that cash in an investment fund that will lend money to someone else's children, right? And I don't know
Mm.
who they are, but it'll be the most qualifying, family of somebody else. And so the question really is, well, if that other family got it through an investment fund versus my own children through direct lending, which improves or doesn't improve inequality? It's not clear to me that there's an obvious answer there. But the net effect, of course, is still that it's a cash subsidy. So the present value of the interest rate discount is still equivalent subsidy value to the children. So yeah, that's very interesting. It's going to be an interesting decade on that point, just with the baby boomers. As I said, it's the pig in the python. It's getting digested through the demographic population pyramid. Um, the baby boomers own the most houses. They own the most of them, which also means they're all going to die at the same, very similar time. And so there'll be a lot of estates to carve up, and it'll be really interesting to see how that plays out in the property market, whether it dampens, price growth for a while, whether it has effects on new housing development because there's this turnover of this very large existing stock of housing, so households can reorganize amongst that huge stock. And remember, the baby boomers have the most spare bedrooms of anyone. So I'm really interested to see how that unfolds. Unfortunately, it's going to happen very slow, so the media won't pay attention. But I imagine in 10 years, I'll be able to look at some data and notice those effects.
Well, here in the U.S., it's predicted that we're going to have about an estimated 30 million baby boomers downsize within the next 5 years. So there's some of the calculations that we're hearing out there, which when you're looking at, home sales that have been in some of the lowest, if you just figure if it were to push 6 million houses through a year, the issue becomes, and this is I'd like to get your opinion on this. What we're seeing, okay, as I was a home builder. I wasn't a very big home builder. I built scattered lots mostly, tore a lot of houses down and rebuilt on a lot. That's the bulk of my career. Rehabbed a lot of houses, but I never, did 100 home subdivision or anything like that. I didn't need it. But I know a lot of these builders that are the infrastructure costs, the soft costs are so expensive. They have, so much money invested in the communities that the only way that they can recoup this money and make all the profits to make all the shareholders satisfied is to build a bigger house. Because when you come into, the fact that you have so many costs that are involved from a money grab or a regulation standpoint, which some may or may not be good.
Mm-hmm.
What are we going to do with all this big house inventory? Because as I see it, a lot of the people that I deal with on a daily basis, they don't care about the big house. They want an affordable house in a safe neighborhood, a nice neighborhood to raise their kids. They don't want mom and dad's, 5,000 square foot house, 6,000 square foot house, or even 40 some hundred square foot house. They can't afford the insurance. They can't afford the upkeep. They can't afford the utility bill. I mean, just the heating and air conditioning alone, because, the U.S. is pushing everything to electric, which is not cheap. And so, we're seeing this. I'm thinking as from my history of building and developing and being in this business, these young kids don't want this stuff. They're living in vans and RVs and, and they're quite happy with it. And we're talking about tiny home movements. What are we going to do with all this inventory when the parents pass on, give it to their kid, and their kid's like, well, what the heck do I do with this?
Well, I guess I'm still an economist, so I do believe the market will adjust, right? So prices will adjust. If insurance becomes expensive for bigger homes, people will buy fewer of them. Developers will realize that, build smaller homes. So it must be the case that people still desire that space. But it's also true that as locations become more valuable, the optimal density, so the ratio of building per land area, goes up. And so also what you see during a big price boom is that you want to divide into smaller lots with bigger houses on each lot. And that process, as you get smaller and smaller, becomes townhouses, attached dwellings, and then apartments. And so a lot of what we see in Australia, it's true, everyone complains, oh, back in my day, the subdivisions had big blocks of land and small houses on them. And now they have small blocks of land with big houses on them. And the answer to that is, yeah, that's just density. That's just more building area per land area. That's what happens in a higher value location. It becomes optimal if you're subdividing to put more building and less land. And so that's sort of a natural outcome. But in terms of the shape of households, so households are getting smaller, I think that will change. There's sort of the effect goes both ways. So people might want smaller households, but then if there are cheap, bigger houses, they might go, well, it's cheaper to us to have grandma live with us and have a big house, right? We adapt to the houses that exist, and we also build houses for the buyers for what they want. So there's sort of like the adaptation or the market adjustment happens in two directions there. So I think we can certainly manage all these big houses. I mean, bigger houses are better in my view. The last thing I'd want to be is like Tokyo and have 30 square meters a person of internal area and a bathroom where I can touch all four walls standing in them while I'm sitting on the toilet or something like that, right? So it's not necessarily a bad thing, and yeah, people relocate and they adjust to what they want. So we can resolve that. I am a general fan of flexibility in the planning system to sort of allow a bit more experimentation in development projects to see what the market might like. Whether you can do some big lots, but then within that subdivision have some small lots of townhouses or apartments. And in Australia, that's definitely the modern way to do it. We don't have many large, 1,000-lot detached house subdivisions. We would have that plus shopping centres, townhouses, apartment areas. It would be like a whole little village with a whole bunch of mixes of sizes and uses. And I think that is the sort of way developers try and meet all those different little market niches and maximize the overall value of the project.
Yeah, we have that too. We call them planned unit developments or PUDs, and then there's also mixed use developments, and but we don't have much of them in Maryland because we don't have a lot of the new development. We have a lot of regulation. It's very hard to clear large parcels of land for these types of things. So what they really do is they buy up the farmland, which sort of isn't very beneficial for people growing fruits and vegetables and farming. But a lot of people say that the farmers, they say, well, it's too hard to do anyway, and we can't make any money at it. So the kids aren't following in their footsteps. So they're happy to sell that land. What would you say? So in the US, prior to this real run up that we've had in asset prices, home prices, we would say that somewhere in the median priced home, the median income, household income, somewhere around that 3x or 4x of their median income would really be an affordable home. So if you're making 100,000 in combined home income, then the home would sell for 300,000 or 400,000. That would be considered affordable. Now, a lot of and all the markets are different. If you go out in the middle of nowhere where there's no jobs, of course, you could still find very affordable housing if you had money. But if you want to be somewhere in a metropolitan area and it's close to the jobs where you can make money, we're seeing a lot of these markets where they're as high as 9 or 10 times median income. The numbers just don't work. What are you experiencing in Australia?
Yeah, so I think Australia wins on a lot of those price to income metrics, 9, 10, 11. I mean, I think the world's worst are like Hong Kong and things like that, where it's 15 or 20 times median income. I'm not sure if you remember in the book, I hate this measure. I think it's a very distracting measure because it doesn't take into account the prevailing rates of return in the economy. So let me give you an example. During COVID, you could get a mortgage for 2 point something percent, right? So in Australia, mortgages pre-COVID were around 4% for those few years from 2017 to 2019. During COVID, we reduced the interest rate so you could get a mortgage for 2%. Now, it's quite interesting, right? Because we do that to make houses more expensive, right? That's why we lower interest rates in the economy, to make houses more expensive so people build more and buy more houses. And then, in the last couple of years, we put interest rates up. Why did we do that? Because we wanted to make it more expensive to buy a house and stop people building because we were worried about inflation. So again, we have this perverse thing of, oh, we aren't building enough homes for prices to come down. Oh, but we don't want anyone to build houses right now. That's why we put interest rates up, to make it more expensive to build a house. So the price to income ratio doesn't make a lot of sense. So if you go back to when you started in development in the late 80s, you might have paid 13% on your mortgage, right? Is that what was the case in the US? So in Australia, I think it peaked around 14 or 15%.
Yeah, that was in the 70s, definitely, but in the late 80s, we were in the probably, and again, this is commercial financing, not for owner occupied, in the 10, 11, 12%. So yeah, not quite that
so not
high,
too
but
dissimilar.
it was double digit though, yes.
So I guess I'd put it this way. You can borrow at 12% interest rate, $100,000 and pay $12,000 per year in interest. So you can rent that money for $12,000 a year. Or during COVID, you could rent $100,000 for $2,000 a year. So 6 times cheaper to rent money, right? Because a loan is just renting money, right? And what households can do is they can either rent money and become their own landlord, or they can rent a house and become a tenant. And during COVID, we made renting money really cheap. And so what happened, instead of, so you might have had a $500,000 house, right? You pay 4% interest pre-COVID. So it was costing you $20,000 to rent the money to buy a $500,000 house. But then during COVID at 2%, you could have borrowed $1 million, right? For that $20,000 a year in interest. So you could have rented money, $1 million worth. And so people, bid up that price until those sort of rates of return on housing were roughly reflecting rates of return elsewhere in the economy. So if there's a structural decline in interest rates, you would expect, or in fact you must have, the price to income ratio or the price to rent ratio rise. If it didn't rise, you would have abnormal rates of return in housing, right? If the price to income ratio is still 3 times, then you'd be having yields on housing of something like 10 or 12% when you can borrow money for 5 or 6%, and just so people would just borrow money at 5 or 6, get 12% and just get free money, right? That can't, economics doesn't allow such arbitrage to persist, right? Something must happen to close that free money loophole. And what usually happens is the price will rise as others try and buy into the market until such time as there's no free money left on the table. So I think the price to income ratio is not going to come back down to historical norms unless interest rates go up back to historical norms. And I'm not sure anyone really wants that, because it's going to, again, make it harder to buy and build homes. So that's the sort of big long-term picture there. And, again, the media loves price to rent ratios because there's a lot of reports out there. Every city, depending on how you measure prices and how you measure incomes, can sort of claim that they're uniquely bad on some metric, right? So Sydney will often say we're the worst, and then the next year it's Melbourne, no, we're the worst. Or no, we're the worst in Asia. Oh no, we're the worst in the Southern Hemisphere. We're the worst here. So it makes for great media, but I think if you don't understand the sort of triangulation of prices, interest rates, and rents, you're going to be a little bit misled.
So if we're not going to see historic rates, which I think over the last 40 to 50 years in the U.S., we're about 7.7% for a mortgage has been the average if we added up all the years and divided it. If we're not going to see interest rates, and by the way, there are some predicting models that say that by 2028, I think, or 2029, that we will actually see double-digit mortgage rates again in the U.S. for a period of time. But if we're not going to see historic mortgage rates and we don't see the wage growth, because, through the years, we've seen where home prices have appreciated sort of in line with, to some degree with wage growth. And that, because obviously, I mean, if you're not looking at a house as a financial asset, but a actual need, a necessity, a roof over your family's head, at what point do you see what will be the repercussions of not raising interest rates and not, seeing home prices fall? What will be the outcome for those that want to buy a house and can't?
Well, I think we're assuming that there's a lot of conditional statements there, like if this continues, if that continues. Well, if people can't buy, the prices will come down, right? Because prices only stay there because someone's paying that price. And we know there's the demographic transition coming, where there's going to be a lot of estates carved up and sold off in the housing sector. So if people can't afford it, the price won't stay up. That's economics. And we saw that, right? Pre-financial crisis, everyone said, oh, this, if this persists, no one will ever buy a house. Well, it didn't persist. And during the 2010s, lots of people bought houses. In fact, the home ownership rate recovered from 63% to 66 point something percent in the US in the second half of the 2010s and after COVID. So if it can't persist, it won't persist. It will adjust. So either prices will come down, interest rates will come down, or household incomes will go up. One or more of those things will happen probably in combination to close that gap to get us back to those sort of normal ratios. And this happens routinely, right? So in the 1870s, we had a big land and housing boom. In the 1880s, in the 1920s, like it's periodically we'll get these waves of sort of what's the Keynesian term? Animal spirits, right? Where everyone's expectations just feed on the others, and then reality comes back and the economy adjusts. So I don't know whether it's going to be a big crash or a weird period of prolonged stagnation for 4 or 5 years, which I think we're halfway through now anyway. It's in Canada, New Zealand, and Australia to some degree for sure. There's been a couple of years of stagnation, and wages will catch up. Rents have been stagnant. Prices have started falling in many places, so that might continue for a little while.
Yeah, I wish I shared your optimism on wage increases. I mean, I think we have a lot of forces that are, that businesses are dealing with. I mean, profitability being one of them. I saw where, and people don't want to admit this because, I mean, they say they work hard, and a lot of people do work hard. But when we had the pandemic boom, and we had, lots of stimulus and people spending money. They were home. They were, redoing their house. They were, going out, taking vacations. Airbnb exploded. I mean, a lot of different things happened over the last 4 years. And, what employers were doing were they were giving actual bonuses for people to not leave. You had companies giving sign-on bonuses to recruit because they were busy and they were in a labor shortage. And so I think we saw a lot of companies extend themselves financially to bring these people on board or to keep them. And now, as we're starting to see, businesses closing up, because, they're not making the money, costs have gone higher, borrowing money has gone higher. A lot of people had inventory that they bought that, that they no longer was desired. We're starting to see the actual reverse of that, where people are cutting labor, cutting costs, layoffs are happening. So I don't know how, and even as an employer, I don't know how I can say that I can, compensate people what they need to be able to buy a home in our market without some kind of correction.
Yeah, it sounds like there's going to be a correction to me.
Yeah.
I think in some ways you've got to trust these economic realities more than the sort of the current. People like to extrapolate linearly from where we are, right? Whatever's happening right now, we always think, oh, this is never going to end, nothing will change. But you've got to sort of trust the economics that if this situation can't persist economically, then it won't persist, right?
Yeah.
And it just so happens that I suspect there'll be a little bit of inflation drag on a little bit, which might mask some of these adjustments, right? So you get a little bit of consumer inflation, but housing asset prices might stay flat. Well, in real terms, that's a correction, right? You might get a little bit of inflation and wages go up, but not quite as much. Well, that's a sort of also helping the correction. So I think, there's a combination of things. I don't expect there'll be a big sort of collapse, recession, financial crisis type repeat. But the economy always adjusts, right? If people can't afford something, then its price goes down until they can and start buying again, even if it's not a smooth ride. I think, property people always talk about the cycle, where we are in the cycle, etc. And I feel like sometimes in the media we forget that, right? So we have stories in Australia where we'll say it's the most expensive time to buy a house ever. In Australia, I'm like, well, but in 2019, it was actually the cheapest time for 25 years, right? How did it suddenly go from the cheapest time to buy to the most expensive time to buy in just 3 or 4 years? No one asks that question. They just take the current situation and pretend that, there's straight lines everywhere. We got to this in a straight line. It's going to go like this forever. And we ignore the ups and downs of the property cycle. And yet we know property developers are very big on the cycle, making sure their balance sheet is robust, prepared for a correction, making sure they can be flexible and not overcommit to too many stages of their new release, things like that. So, yeah, that's just something I think that's worth keeping in mind. Every time I think the media has finally really gotten to a point, like in Australia, we've had falling building approvals, right? So this is the last stage of development where you check your design complies with the building code. We had falling building approvals for 2 years, which was the intention, right? We raised interest rates, so it was more expensive to buy and build houses. And I said, and everyone said, oh, if this persists, we won't build enough houses for everyone in the future. And I said, but it's not going to persist. We're at a historic low in a graph that goes like this, up and down. Why would you draw a straight line across the bottom? Why wouldn't you expect it to bounce up like it has every other time? And of course, the last few months' data has showed a recovery, right? As construction prices and materials have stopped rising and in some cases fallen, some of those projects are getting pushed out now. So, yeah, that's always good to keep in mind.
Yeah. What is your overall opinion of the results of our election? What do you think the Trump administration? I mean, as Australians, what do you kind of, what do you all say about us Americans?
Look, it's a mixed bag. I think Australia's not quite as polarized as the US. I think we can sort of joke about Trump in the company of the left and the right of politics. I guess it's very hard to know. I mean, my personal opinion is that it's quite clear that the establishment politicians were not listening to a lot of the concerns of the people, and this was a sort of rejection of that. Like, if you're not going to listen to us, we're going to take this crazy guy who's going to he listens to us. Who knows if he knows what to do? And I think the other thing about Trump, not only is he, creating the most entertaining timeline, I think a lot, we shouldn't read too much into his actions. I think a lot of it is just testing the water. I don't think he's got strong convictions. It's hard. What do I know? I'm just an Aussie guy observing. But I sort of take a more wait and see what sticks, right? He'll cause a little bit of chaos. Maybe some good things will stick, and maybe people get sick of him. I have no idea. I just, if I zoom out for a sec, I think the interesting part is that the Democrats or the Republicans as a party couldn't come up with a sensible candidate and a policy regime that people could vote for above Trump for a second term, which is to me kind of weird, and it's something that happens here as well in Australia. The opposition party will put forward a very unlikable candidate and policies that no one asked for or really wanted and aren't what's really topical. And I feel like you're doing a really bad job, right, of being in opposition. Now, you can have your beliefs, but you got to at least try and meet the people where they are and bring them in your direction. But just getting an unlikable person and having policies that no one wants is not going to get you there. So that would be my sort of bigger picture reflection on the state of politics, because I think it's very hard to take seriously much of what Trump says or even does. And, we just got to wait and see what sticks. The tariffs, who knows? Who knows what the tariff will be next week? I suspect people like his attempts to sort of minimize US military commitments around the world, which is something that, the Democrats didn't seem so interested in, or at least they didn't communicate it well if they were. But again, I don't know if his actual approach is going to work or not. Like, I think his approach to everything is high risk and has a chance of backfiring. But yeah, I don't think I've got much more to say on any details, just a sort of big picture way to have a lens to all this and try not to get too caught up in the day-to-day shenanigans.
Yeah, well, I like to ask people that are, out of the country, that out of the U.S., that to get sort of like their opinion on what they hear as far as, news and propaganda, and, because I'm sure there's a lot of that going on too, that is being reported, and it's interesting. Well, Dr. Cameron Murray, I tell you, I really have enjoyed our time together, and I think your take on the market is certainly, worth pondering and thinking about. I mean, I a lot of what I hear you say, it'd be interesting to see what happens. I mean, history, hindsight's always crystal clear. It's always 2020, right? So we can look back, like you had said. It will be interesting 10 years from now to actually look back and see this time period that, in our lifetime, I mean, we've lived through it. And of course, history, there's been all kinds of ups and downs and wars and, different things happen, right? That
Yeah.
so it will be interesting. But I really appreciate your time, and hopefully we can get you back and we can kind of catch up on what's happening in the U.S. and Australia and see how it compares.
Yeah, that sounds good. If anyone listening wants to check out my writing, fresheconomicthinking.com is the best place where I write my weekly newsletter.
Excellent.
Very focused on property, but lots of other big economic topics as well.
Awesome. Yeah, we'll definitely, all those links will be published below, and we hope people check you out and get familiar with their work.
All right. Thanks for having me, Todd.
Thank you. We'll talk to you soon. Thanks so much for watching. If you like the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.